Hey traders, I hope that everyone is enjoying the recent bull run. In today's video, I will reveal one of the most profitable RSI trading strategies ever. But before we start, I have an announcement to make. Most of you guys were asking me to use my own voice instead of the robo voice that I use. And you are the reason that this channel is still alive today. So I decided to listen to you guys and I gave it a shot for this video only. Please comment me down your feedback, and if you think that robo voice was better and more understandable than my English, then I promise you it will be the last video that I use my real voice. So you will decide the future of this channel. Please take 5 seconds to give me a feedback. As I promised, I will reveal one of the most profitable RSI strategies ever. It is a multi-time frame RSI divergence strategy, and it is definitely not for beginners. So if you're a beginner, please watch my old videos first and come here when you have more experience. I will try to explain everything step by step, but it can be too much if you're a total beginner. Please don't hesitate to ask me anything you want. Before we dive into the tutorial, please don't forget to like and subscribe for more trading videos. Okay, before we start, let me explain the strategy we will use. We will use both the hidden and the regular RSI divergence in our strategy, and we will have a multi-time frame approach. In the bigger time frame, we will look for a trend and a hidden divergence. And then we will go to the lower time frame and look for a regular divergence to open our position. Don't worry if it sounded complicated. We will go step by step and I will try to explain everything as simple as possible. In order to understand this strategy, you must know the regular and the hidden RSI divergence. So I will start by explaining them. I really believe that both of them should be in your toolbox as a trader. So let's start with the regular RSI divergence. RSI shows us the overbought and oversold levels, so we should expect it to mirror price movements. Let me show you what I mean. We can see a clear downtrend in this example. Price constantly makes lower lows and RSI mirrors them. Let me explain. You can see the price starts to decrease here and the RSI decreases with it too. Price makes a lower low after a retracement and RSI makes a lower low too. And the same thing happens one more time. Here we get a retracement followed by a lower low. As you see, RSI mirrors the price movement and makes a lower low too. Everything was normal until now, but this time things get a little tipsy. You can see that the price makes a lower low, but this time RSI doesn't mirror the price movement and it makes a higher low. This is called the bullish RSI divergence, and it indicates that a price pivot might occur soon. You can see that the trend changes after the RSI divergence in this example, and the price makes a new high. So we will use the regular RSI divergence to catch the lowest or the highest point before a trend change occurs. Before we dive into the hidden divergence, please let me show you a bearish RSI divergence example too. Bearish RSI divergence is the exact opposite of the bullish one, and we will use it to catch short entries. You can see an uptrend on the chart now. This time the price makes higher highs and higher lows. Let's check if the RSI mirrors the price. As you see, the price makes a high here and after a retracement it makes a higher high. But RSI doesn't follow the price and it makes a lower high. So there is a bearish RSI divergence, and it indicates a price pivot might occur. As you see, the price falls strongly after the divergence. I hope that you understood the regular RSI divergence now, but if you have any questions, don't hesitate to shoot them up. The regular RSI divergence can be really profitable if it is used correctly. In order to increase the win rate, we will combine it with the hidden RSI divergence. The hidden divergence is a little different than the regular one. It indicates a trend continuation. So this time, instead of using the divergence to look for a reversal opportunity, we will use it to hop on trends. Let me show you an example. Here you can see that there is a clear uptrend. Price starts to move up and it constantly makes higher lows. The RSI line is following the same pattern at first, but here on the fourth higher low, you can see that the RSI indicator makes a lower low. It is called the hidden RSI divergence. It is way different than the regular divergence because it indicates that trend is most likely to continue. We will use the hidden divergence to hop on trends. Before moving to the strategy, please let me share the differences between the hidden and regular divergence. The regular divergence indicates a trend reversal because it shows that the momentum is leaving the trend, The hidden divergence indicates a trend continuation because there is momentum coming into the trend. The most important thing to remember is how we will draw the divergence. In a downtrend, we will draw the regular divergence from the lows of the price and the indicator. However, the hidden divergence is drawn from the lows of the price and the indicator when there is an uptrend. Notice that there is a downtrend on the left chart, and we draw the divergence from the lows of the price and the indicator. Even if my drawing is not so clear, there is an uptrend on the right chart and we draw the divergence from the lows. Sorry if it sounded too complicated. If you are interested, I can create a video that I will explain and compare both the hidden and the regular divergence in full detail. I don't want to go too deep in this video to keep it short. I just want to show you a bearish hidden divergence example real quick. Notice that there is a clear downtrend now. Price constantly makes lower lows and lower highs. And we will try to find a hidden bearish divergence to decide if the negative trend will continue or not. As you remember, in a negative trend, we have to check the highs of the price and the indicator. We will be searching for a divergence. Here on the first retracement, the price makes a lower high and RSI mirrors the price movement. However, on the second one, the price makes a lower high, but the indicator makes a higher high. So we have a bearish hidden divergence. It indicates that the negative trend is most likely to continue. I think it was enough with the divergences. As I told you, I can create a full tutorial about them if you are interested, but it is time to move on to our strategy now. I will try to explain it with examples. As I told you, we will use a multi-timeframe approach. We will start analyzing the chart from the bigger time frame and we will move to the smaller time frame to make our entry. To decide the time frame, you have a couple of options. You can use 1 hour as a bigger time frame and move to either a 15-minute or 5-minute chart. Or you can use 30 minutes as a bigger time frame and then move to a 5-minute chart. But don't be shy to try out different time frames. As you know, trading is all about backtesting. The main rule here is the bigger time frame you choose should be at least 4 times bigger than the smaller time frame. After selecting a time frame, we should look for entries. But before we open a position, we have to decide if there is a positive or a negative trend. If you watched my previous videos, you might guess the easiest way to do it. We will add the 200 period exponential moving average to our chart and we will only look to go long if the price is above the EMA. And if it is below the average, we will only take short opportunities. Right now, we are looking at the hourly chart of US dollar to yen. And here you can see that price just broke above the 200 EMA. So we will look for long opportunities. To open a position, we have to be sure that the trend is most likely to continue. We will look for a hidden bullish divergence to be sure. Notice that price constantly makes higher highs and higher lows. To look for a hidden divergence, we should compare the lows of the price and the indicator. Here you can see that price made a higher low, but the RSI indicator did not follow the price movement and made a lower low. It means there is a hidden bullish divergence and the trend is most likely to continue. So we will move to the lower time frame to search for possible entries. You can either go to the 15-minute chart or the 5-minute one. I will stick with the 15-minute one. In the smaller time frame, we will look for a regular bullish divergence to decide if the pullback is over. Notice that on the lower time frame, price constantly makes lower lows and lower highs. So there is a short-term negative trend. To look for a regular bullish divergence, we will compare the lows of the price and the indicator. Here you can see that price makes a lower low, but the RSI indicator does not mirror the price movement and it made a higher low. It is the signal that we are looking for, because it means the pullback is probably over and a reversal is most likely to occur. But we will not open a position as soon as we spot a divergence. To increase the win rate, we will look for a second confirmation, such as a bullish candlestick pattern. Here you can see a bullish engulfing pattern, because the green candle completely engulfs the previous red candle. That is our entry signal. We will open a position at the opening of the next candle. We will put our stop loss a couple of pips below the lowest point of the price. If you put it too tight, your position can be closed just before a huge price increase and you can miss out a huge win. So you should give your trades enough space to breathe. For the take profit target, you have many options. You can aim for a fixed risk reward ratio of 1.5. But this is not what I prefer. I like to ride trends risk-free. To accomplish that, I usually open my trade with a fixed risk-reward ratio of 1.5. I set an alert close to my take profit target, and as soon as the price touches my alert point, I split my position into two. I don't change the take profit or stop loss points for half of my position, but for the other half, I increase my stop loss to the entry point at first. And I keep increasing it constantly as long as the price keeps increasing. With this exit strategy, you can enjoy riding trends risk-free, because your stop loss point will be higher than your entry point. Sorry if it sounded complicated. I will not explain exit strategies in full detail because it can take a whole video. And this video is already longer than I planned. And I want to spend the rest of our time showing you a short example. Here we are looking at the hourly chart of oil. Price is below the EMA line, so we will only look to go short. We will look for a hidden bearish divergence on the bigger time frame. Notice that price makes a lower high here, but the indicator makes a higher high. It means the trend is most likely to continue. We will move to the lower time frame and look for a regular bearish divergence. On the lower time frame, price constantly makes higher highs, so there's a short-term positive trend, and we will look for a bearish regular divergence. You can see that even if the price makes higher highs, the indicator made a lower high there, so we can look for a trade opportunity. Notice that the price has tested above the EMA line, so this time it will be best to wait until a candle closes below the EMA line as confirmation. I will open a position here and put my stop loss just above the highest point. Just like the long entry, you can set a fixed stop loss or divide your position into half and continue riding the trend. I hope that you understood the strategy, but if you have any questions, don't hesitate to ask them in the comments section. Also, please comment down about the voice you prefer. If you prefer the robo voice, just write that down and I will continue to use it without any hard feelings. If you find this video helpful, please consider liking it for the YouTube algorithm. And if you are interested in more trading videos, you can subscribe to our channel. Have a profitable day, everyone.